Today, we're diving into three deeply discounted dividend stocks that I think deserve your attention right now. These are companies with strong brands, consistent dividend payouts, and have beaten stock prices, a recipe that can offer long term investors some serious opportunity. We'll be breaking down these stocks with their current valuations, dividend strength, and growth outlook. If you're serious about building passive income and growing your wealth, stick around till the end. And hey, don't forget to like, subscribe, and comment your favorite dividend stock of 2025 down below. Let's get straight to it. First up, we have Target. Over the past couple of years, Target has faced real challenges. Inflation cut into their consumer spending, theft issues hit margins, and inventory mismanagement led to markdowns. Because of these headwinds, Target stock is still trading far below its high of around $250 back in 2021. And as of right now, it's trading at about $89 per share. And its 52-week high was $86, and its 52-week low was, oh, I'm sorry, 52-week low was $86, 52-week high was 161. So I really think this is a good price to buy in if you want to buy dividend, yields at a cheaper price. Diving into the valuation, it looks like the PE ratio for Target is 10.46, which is pretty good, but always just because a stock price to earnings ratio is lower doesn't always guarantee it's a good company, but it's a good signal that it is. So don't put all your eggs in one basket for this one. But historically, Target is traded at much higher, so we're pretty much getting a discount here. And that also brings me up to the dividend yield. This is what Target shines in. Target is a dividend king, meaning it raised its dividend for over 50 years straight, and right now it's sitting at about a 5.02%, and the payout ratio is sitting at about 50 to 60% of earnings, which is very sustainable. And if we compare Target to Walmart here, you can see that Walmart is trading at a 38.88 price to earnings ratio, and it has a lower dividend yield as well. So technically, if you're looking to buy income plus an upside, Target actually looks more attractive here. Plus, Walmart is a little higher in its share price as well, with the 52-week high being 103, and it's pretty much near its 52-week high. So this wouldn't be a good stock to buy as opposed to buying Target if you want to buy some consumer defense stocks. Next, let's go ahead and move to Pfizer. We all know Pfizer is a company behind one of the most widely distributed COVID vaccines. That was a revenue windfall, but once the vaccine demand lower slowed, Pfizer's stock collapsed, falling from around $50 in 2021 to about a low $20 today, and it's sitting at about $27, which is technically high 20s, but as you can see, it shot from the mid 20s to high 20s today. And just like Target, Pfizer is sitting at a nice price to earnings ratio, which is at about 13.55, which is very good buying in now compared to its 52-week high, because it's just better to buy these stocks at the current price that they're at, and trading at a 13 is pretty damn solid. And if I go ahead and show you guys the dividend yield, this is the biggest attraction right here, a 6.7% dividend yield, which is pretty solid. That's higher than its peers like Johnson & Johnson and Merck. And while payout ratios are higher right now because of declining earnings, Pfizer has cash flow and assets to sustain its dividend. Pfizer has over 100 products in its pipeline, including cancer drugs and rare disease treatments. They've made big acquisitions in Seagen, which expands their oncology portfolio. Healthcare demand is non-cyclical. People need these treatments in good and bad times. And if we compare it to stocks like J&J and Merck, they trade at richer valuations with lower dividend yields. Pfizer is the clear deep value play in pharma right now. And my investor takeaway at the end of the day is that if you're an investor, especially dividend investor with patience, Pfizer offers both high income and potential rebound growth. You're essentially locking in a healthcare giant at a fire sale price. And finally, let's talk about Exxon Mobil. Exxon is one of the biggest energy companies in the world, and while oil prices have been volatile, Exxon has proven time and time again that it can deliver shareholder value. The stock had a huge run during the 21 to 22 energy boom, but now it's cooled off, creating a better buying opportunity. And if we go and check out the valuation, we can say that Exxon trades at a 15.99 price to earnings ratio, almost 16, which is much lower than the average market. For a company of its size and stability, that's a clear, valuable signal. As you can see, ExxonMobil offers a 3 to 4% dividend yield with decades of consecutive payouts. Even during oil crashes, Exxon maintained its dividend yield, proving its commitment to shareholders. There also a global oil demand is projected to remain strong for years, and Exxon is expanding into liquefied natural gases, which is in a high demand worldwide. And the last thing they're doing is that they're investing in carbon capture and alternative energy, positioning themselves for long-term growth. And as a dividend investor, I think that's very good news, and I don't see why you don't see it like that too. If we go ahead and compare Exxon to its closest peer, Chevron, we can see that it trades at a higher share price and it also trades at a higher valuation, being a 20.04 price to earnings ratio. And honestly, Exxon's size, efficiency, and balance sheet make it arguably the safer pick if you want income plus growth. And honestly, my last takeaway is that Exxon is not just an oil play, it's a cash machine that rewards shareholders with dividends and buybacks while also hedging against inflation. If you want energy exposure, this is a name to seriously consider. So there you have it. Target, Pfizer, and Exxon Mobil, three deeply discounted dividend stocks that combine value, yield, and long-term stability. Target is a dividend king traded at a discount waiting for retail recovery. Pfizer, a beaten down pharma giant with a high yield and massive pipeline. And lastly, Exxon Mobil, an energy powerhouse with the reliable dividends and inflation protection. Remember, these aren't get rich quick stocks. They're long-term income generating plays. If you reinvest the dividends, hold patiently, and ignore short-term volatility, these kinds of investments can completely transform your wealth over time. And if you enjoyed this breakdown, hit that like button, subscribe for more dividend investing content, and comment below which one of these three stocks you'd buy today. Thanks for watching, and always keep building that wealth one dividend at a time. Peace.